I'm Alicia Barry and welcome to Close of Business. Another day, another record. That's been the story of the Australian share market in the past weeks. The ASX has broken through 9,000 points, making history and pumping up super accounts. The market is awash with cash and exuberance, but as David Taylor reports, it's Wall Street that could end the party.
And the share market has rebounded to record new highs.
So it's risen by 1,000 points in the past 12 months.
It went above 9,000 points for the first time ever.
FOMO, interest rate cuts and an easing of global tensions have sent the share market into record territory.
What we've seen recently is evidence that the boom has turned into the early stages of a bubble.
After the GFC and COVID, fund manager Roger Montgomery says enormous amounts of credit is sloshing through global markets and it's looking for a home.
So the ability to lend money has been going up and people are borrowing because that capacity is there. There's less friction. They're willing to take on risk and markets have been going up and that helps fuel that acceptance of risk. So it's risk on, if you like.
Made easier by central bankers cutting rates, with more to come in the world's biggest economy.
The shifting balance of risks may warrant adjusting our policy stance.
Traders say cash is already rotating out of Wall Street into the Australian share market.
You've seen money coming into the MSCI Asia indices, which includes Australia, and when that money comes in, the money goes into our biggest stocks.
Marcus Padley says stockbrokers offer index funds mirroring the performance of the ASX 200, with the big banks making up roughly a quarter of them.
If you go back to the start of the most recent bull market, November 2023, the bank sector's up 60%, the market's up 28%, and the resources sector is down 3%. So it's all driven by banks.
The stock price of Australia's biggest company, the Commonwealth Bank, is up more than 20% in a year, even though its latest profit result disappointed investors.
Many of those factors aren't so much about the bank's fundamentals improving that much. It's got more to do with the fact that there's been a weight of money coming into it, which has pushed the stock higher.
Analysts reckon the market's irrational behaviour can be best seen in CSL. Its underwhelming financial results, its decision to cut 3,000 jobs and spin off its vaccine division into a separate company saw the share price plunge.
It seems companies have given away the idea of a confession season and now just prepared to dump 6 months of information on one day and not warn the market. That's what's going on with CSL. Otherwise, they're a very sensible, solid company.
The record run of the Australian stock market is perhaps best captured by the performance of superannuation, up as much as 12% over the past 12 months. Now, there are risks out there, but they're not locally based. Analysts say any big fall on the Australian share market is likely to come from a crash on Wall Street.
There's anywhere from an 80 to 90% correlation of our market with the US market. But if there is a market drop, we in the US will inevitably follow suit.
I know in time it will all normalise again. It's just a matter of time. We don't know what will cause it, but it will. And when it does, it will be very painful for those people who have behaved irrationally.
And for the many millions of Australians with superannuation caught in the crossfire.
To the share market, which drifted lower this week. By Friday, the ASX 200 and the All Ords ended down by around 0.75% each. Gemma Dale from NAB Trade joined me at the end of the trading week. Gemma, reporting season has seen stocks swing wildly on account of the earnings. Have the earnings justified these moves?
Such a good question. When you look in aggregate, earnings have been soft. You know, it's been a fairly patchy reporting season. You see some really strong performances from those better quality franchises and particularly around cost management and so on. And I think the point you're making is that the response to some of those weaker numbers have been really dramatic. That's It's been a feature of recent reporting seasons. It just does feel like it's heating up a little bit. You see these dramatic responses. Certainly on NabTrade, we see our investors then responding to the price action going, this looks quite exciting. But we're seeing really dramatic swings and then a couple of days for really the market to bed down whether they think that reaction is reasonable or whether it was a little bit overdone.
And what's the role of, say, AI?
Yeah, this is the question, right? The biggest issue is they're so quick, right? They're happening so quickly. We've had big reactions in the past, but they just haven't happened within seconds or minutes the way they're happening now. Most of the response I get from those who are a little closer to these things than I am is that it is absolutely algorithmic trading, and it is generally sort of pod shops, so small numbers of individuals within a business who run a single strategy responding very quickly. Whether it's AI that's driving their trading behaviour, it's hard to say, or they're just running the algorithms they've run in the past, different question.
And when we're talking about the moves, there were big gains in Qantas, for example, then major sell-offs in heavyweights like Woolworths. Some investors are carrying a lot of pain as a result, while there's other winners.
Yeah, you've seen a fair bit of that. And as I said, our investors are really looking at some of these results and going, are they a little bit overdone? But the quality franchises are holding up very well. Qantas has obviously come through very strongly, as you say. Woolworths, a lot of pain, but Coles on the flip side performing really strongly. So that one's quite interesting. You've got, two very close competitors bifurcating in the market, very different performance. And so we're seeing a bit of that sort of thing happening too. It's about the quality of the underlying business, not the sector necessarily.
And we're going to look at Coles and Woolworths a little later in the show. But what do you do in this market? I read one fund manager say the best place to put money is in businesses tied to increasing asset values, mainly banks perhaps, but not increased activity. So fundamentals out the window.
Macro factors are not fabulous at the moment, but they're holding up. There is some resilience, for the worst of the downside, and those companies that have real exposure to activity. So you looked at Reece and James Hardie and so on that got absolutely smashed and really poor performance there, and then those that are sort of hanging in quite well. Banks still doing really well. They're up 5% over the month. I know CBA's off its highs, but its highs were just unbelievable. Well above 25 times for a bank is still crazy. A lot of investors are still feeling that's where the value is, and even if they don't necessarily want to buy at these prices, they will hang on to it.
And our earlier story highlighted a broad sell-off risk could come from Wall Street. Is that NAB's view?
I think it is absolutely worthwhile considering some of the macro risks are global rather than domestic. The issues around Fed independence, for example, fracturing in the bond market. We're seeing Japanese bond yields rising. There are some just really significant offshore threats that could lead to market dislocations. You've also got bizarre things like Nvidia being 8% of the market now. I mean, it's quite extraordinary what has been happening, and we've been following the US market higher. If it does come off for any reason, frankly, I think we would expect to see a bit of weakness.
Gemma Dale, thank you.
Thank you for having me.
Qantas share price has soared to new heights after the airline announced a bumper profit, a fleet renewal and a special dividend for shareholders. Investors lapped up the good news, but the airline's journey to profitability has been bumpy, as Rihanna Whitson reports.
All smiles after the turbulence of another self-inflicted PR disaster. The Qantas boss talking up bumper profits.
Australians' love of travel has continued to drive strong demand,
helped by a rebound in corporate travel.
We have also today announced an order for a further 20 XLRs for Qantas. 16 of these aircraft will have a lie-flat bed in business class.
The airline forked out $3.9 billion as it accelerated its fleet renewal program, but still posted a near record profit, which soared 28% to $1.6 billion, as Qantas and Jetstar carried an extra 4 million passengers during the year. Qantas said 82% of its flights were on time, compared to 76% for Jetstar. Shareholders will receive a final dividend of 16.5 cents a share and a special dividend of 9.9 cents.
These results are not a flash in the pan, that's for sure. They are results that any airline or any company would be very proud of.
just don't expect fares to drop as a result.
We're not seeing any reduction in fares. We haven't seen a particularly large increase in fares. There are probably fewer low fares around because of the shortage of capacity, and that's not really going to change.
Vanessa Hudson insists a cultural shift is underway after the airline's record-breaking $90 million fine for illegally sacking 1,800 grounds crew during the pandemic.
I am genuinely sorry for the impact that losing their job and the subsequent 5-year legal process has had on them.
A public apology 10 days after Federal Court Judge Michael Lee called out Qantas's performative remorse and Ms Hudson for not showing up.
Honestly, there was nothing more for me to add.
While the Qantas boss is keen to move on, the scorch mark of the scathing Federal Court judgment remains. It described an aggressive company more concerned about its own reputation than breaking the law. Now there are rumblings of a shareholder revolt, with attention turning to executive pay and bonuses.
We've got a current climate at the moment where it's really boom and bust for Qantas. When they're making record profits, we're seeing that siphoned off to executive pay, and that really needs to stop.
The airline also faces the looming legal fallout from the massive cyber attack, affecting 5.7 million customers.
Whilst we are not paying compensation, what we are doing is we are focused on continuing to support our customers.
This Qantas frequent flyer caught up in the breach says the airline has been anything but helpful.
All the priority goes to shareholders, but it's greed, it's corporate greed, and I don't think that Qantas will get rid of corporate greed.
As for whether Vanessa Hudson and other senior executives deserve a bonus...
No, absolutely not. They should not at all get their full bonuses.
With the finances of Qantas intact, a call for leadership to pay.
Coles has emerged as a clear winner in the supermarket wars this week. Investors marked Coles' performance up in sharp contrast to arch-rival Woolworths, its shares diving on disappointing results. Analysts say weaker than expected sales growth suggests Woolworths customers are voting with their feet. Here's Amelia Terzon.
There's talk of a price war as some Australians are switching where they shop.
We often sort of probably do the Aldi shop first and then top up with things that we can't get from Aldi.
The variety of products is not the same in Aldi's as it is in Woolworths or Coles.
The big two supermarkets are pushing home brand under pressure from Aldi.
It's a highly competitive market right now in groceries and food overall.
Well, we're running our own race, and we know that there are real reasons that a customer would shop with Coles.
Both of the major supermarkets foreshadowed their results with announcements about price drops on hundreds of products.
Aldi has certainly put downward pressure on pricing. I think the battle is playing out, though, in private label. Woolworths results out today showing a 5% growth in their exclusive brands, certainly higher than their sales of stores, about 1.7%.
Coles' home brand range is a huge part of its sales.
We've seen great growth in our own brand products this year at 5.7%. And interestingly, that premium tier of Coles Finest has been our fastest growing tier at 13%.
Looking further at the figures, one of the big two is winning.
The performance that we delivered in F25 was well below our expectations.
Woolworths made a full-year profit of $963 million, but excluding last year's write-downs and some items this year, underlying profit fell 19%. Margins were also squeezed from discounting, higher costs and store theft, while Coles posted a $1 billion profit and managed to grow its margins from tackling theft and banking savings from automation.
It'd be great if they passed on some of those rewards to the customers, I think.
Well, good luck to their shareholders. It's a bit hard. It's hard to reconcile that with what's happening in the rest of the community.
After years of allegations about price gouging and high prices, the latest inflation figures show that grocery price rises are easing, hovering around 3% annually.
What's really problematic is that there's some categories that are still causing headaches for consumers, and what you don't see is a lot of deflation inside the food basket, so food prices aren't coming down. There is investment from the retailers to try and at least stabilise pricing for food and where possible bring prices down through increased promotional activity and things like that. But there's also a focus on trying to improve affordability, and that comes through trying to expand their own brand product range.
With all of this talk about lower prices, you'd almost forget that Coles and Woolworths are still battling it out with the consumer watchdog over allegations of fake discounts. And when it comes to home brand, the ACCC also recently noted that that's where they make their margins.
Some things are double the price, most things seem like they're probably 50% more.
I've noticed an increase over the last few years, definitely with 3 mouths to feed.
Amanda Bardwell knows that she has got work to do. The CEO also spent her first year in the role dealing with strikes that upended the supermarket supply chain.
It has been a very disruptive year. There is work for us to do to rebuild customer trust.
And now Woolies at least needs to woo investors as well as the supermarket share price tanks on its results.
Donald Trump has been ramping up his attacks on the independence of the US Federal Reserve. Now a legal battle is underway that could further challenge or cement the bank's autonomy. US Federal Reserve Governor Lisa Cook is taking the US president to court, claiming his attempt to fire her for cause is unlawful. Trump has accused Cook of committing mortgage fraud in 2021, a year before she joined the central bank's governing body. Lisa Cook denies any wrongdoing. Trump has also repeatedly attacked Fed Chair Jerome Powell for not cutting rates and over the Fed's multi-billion-dollar renovation. Meddling in the US central bank is just one example of the US's march towards state capitalism, as the Republican president, just 6 months into the job, rolls out his MAGA agenda, where the free market is out and autocratic government is in. The senior market strategist for Rabobank Research, Ben Picton, joined me. Ben Picton, welcome to Close of Business.
Thank you for having me.
Now, the US Federal Reserve is one of the pillars of the global financial system and the global economy. Trump is constantly attacking this institution. What is the end goal here?
Well, the end goal is the complete politicisation of the Fed. The US president wants control over all levers of policy in the United States, including monetary policy. So he wants to use monetary policy in the United States to push forward the MAGA agenda. There is a broad economic strategy, and having access to cheap capital is an important part of that. So he wants to politicise the Fed.
And of course, this is creating a bit of a danger of causing a crisis of confidence in the US, particularly when it comes to the dollar.
Yeah, so this may shake markets. So what we're seeing is kind of a throwing out of the orthodoxy that markets are sacrosanct and that you can't do anything that might impact upon free markets. We're entering into this period where the writ of free markets no longer runs. We're seeing intervention more and more. We're seeing a breaking down of the liberal global economic system. And what we're seeing put in its place is much more nationalistic, much more protectionist, not just in the United States, but all around the world we're seeing this trend. So it's a totally different economic environment that we're moving into that we've been accustomed to over the last 30 or 40 years.
And how do you define state capitalism, and just how prevalent is it really in the US economy now?
Well, in the US economy at the moment, state capitalism is not prevalent at all. So state capitalism is effectively government control of the means of production through ownership of state-owned enterprises or stakes in state-owned enterprises. That's very common in lots of other countries around the world. China most conspicuously uses state-owned enterprises in lots of strategic parts of the economy. Very common over there. It's about 30 to 40% of total GDP. In the United States, state-owned enterprises are really not a thing. But all of a sudden, we're starting to see Donald Trump is changing that. The US government is becoming much more active in managing the economy and is taking a slice of some of the biggest pieces of corporate America.
Like Intel, for example?
Absolutely. So a 10% stake in Intel. They see semiconductors, microchips as a strategic sector, a strategic supply chain that they want to have some control over.
I mean, it's quite interesting because you mentioned China there. It does seem as though the Trump administration is using China's playbook back on China.
Absolutely. So they are competing with China. They're addressing competition from China, ideological, economic and military competition from China, by mirroring back the Chinese playbook to China and to the rest of the world. So China has long had state capitalism. China has long had protectionism, intervention in markets, subsidies, state control over monetary policy. Suddenly, we're seeing the United States starting to do many of these same things.
Well, as countries start to look inward, led by this move in the United States, what does that mean for the global economy?
Well, it's going to be a very different economy. So something that we've been talking to clients about recently is the concept of a global price for anything is now up for review. So a good example of that is the idea of the global price of oil. There no longer is a global price of oil. There's two prices. There's the Russian price, cheap, and there's the global price, more expensive. And if you want to buy Russian oil, like India does, you will be punished by the United States through tariffs. So this is the game that's now being played, where we're seeing walls being erected between different markets around the world, and that means the goods don't flow, and if the goods don't flow, the prices don't level out.
I mean, just more on a sort of, if we look at the economic data that came out of the US at the end of the week, we saw a revision upwards to the GDP reading. I mean, it looks like the US economy is holding up pretty well in the face of all these threats.
Yeah, so far it is. And by design to a large extent as well. So there's a lot of volatility in these GDP figures. We had a negative print in Q1 because the United States had a big surge of imports as companies tried to front run the imposition of tariffs. But then we saw a big correction in Q2 when there were less imports and more exports. But we're also seeing quite strong household consumption, and we're also seeing quite a lot of investment in the United States as well. So the combination of lower regulation, lower tax, cheap energy, and leaning on the central bank to provide cheap capital, and twisting the arms of allies and of companies to invest more money inside America, rebuild production in America. It looks like it's starting to bear fruit.
Ben Picton, thank you so much.
Thank you.
It's the box ticking exercise that could cost your loved ones a small fortune. More than 6 million people will have no say in who inherits their superannuation because they've failed to correctly nominate a beneficiary. That's according to new research from Super Consumers Australia. The advocacy group is urging Australians to ensure their choice is legally binding. Nasim Kadem reports.
I was tongue-tied at the reception. I don't know what I said.
When John Gilmore lost his wife for 56 years, the last thing he needed was a fight with her super fund.
She had ovarian cancer, which was diagnosed the previous February, and she gradually went downhill after that. It's not worth doing it.
John was listed on Julie's super as a non-binding beneficiary, meaning he had to prove he was eligible to get the money.
They asked for an extraordinary number of documents. They wanted not only a death certificate and those things. They wanted a marriage certificate certified. They even came up with the interesting demand to say, how do we know that Julie existed?
New research suggests at least 6.5 million Australians won't have a say in who inherits their superannuation because they don't have a death benefit nomination. About 4.3 million say they have a binding nomination, but researchers believe the number could be lower.
Some of that is due to legal barriers, which require 2 wet signatures from witnesses for any nomination that you make. So it's all very manual. It's not something you can do online at every fund. And so pretty easily people can, if they're not reminded, can have these nominations lapse.
A spokesman for REST said it can't comment on individual claims, but for the past 2 years the fund had made the claims process simpler and faster.
If anything happened to us, we were going to leave our superannuation to our child, This is a letter from the 9th of November stating...
Before Kelly's ex-husband passed away, she agreed with him he would leave most of the $600,000 he had in super to their son Zach, who has a disability. Because the nomination was non-binding, Zach's uncle, who was living with his father after being released from prison, stepped in and made a claim.
If you have a non-binding superannuation, your wishes are not set in stone. Anyone can come in and claim against the superannuation, especially if they've lived with the member. My son was able
We've concealed their identities to protect their safety. Australian Super told ABC News binding nominations may expire after 3 years, and it's investigating legal options to allow members to use digital signatures. It's among many funds that have come under fire in a review by the corporate watchdog, which wants them to make it easier for members to make binding nominations.
Over half of them were communicating in a way that the average Australian reading age can't understand, let alone those where English is not the first language.
There are growing calls for the federal government to undertake an independent review of how the super death benefit system's working. Consumer groups and lawyers say there need to be mandatory timeframes for super funds to respond to claims so that they don't drag out for years.
Presently, super funds are reluctant to exchange one individual's claim with another individual due to privacy concerns, and we often don't see the exchange of competing claim materials until we get to AFCA, the Australian Financial Complaints Authority, where these disputes go to try and get untangled.
My ex-partner's sibling is...
Australian Super awarded just 20% of the money to Kelly's son Zach and the rest to his uncle. AFCA overruled that, recommending a 50-50 split, which the uncle is contesting.
My child will most likely not be able to buy a house. My child will most likely fall through the cracks.
A sad possibility that could be avoided with a binding nomination.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.